Hi there everybody, it's Chris here from Serene Education. It's going to be doing the 4 majors analysis update for the first week of March 2015. So that's the 1st to the 7th of March 2015. Going to have a look at the euro against US dollar on the monthly just to see how this month has progressed. You can see going into March now, you can see that last week's candle, this is February's candle. You can quite clearly see that the actual candle has closed at a monthly fib level here at the 61.8 level and just slightly lower than that monthly fib level. You can see January in fact actually found support. We saw a bit of pullback or consolidation through February to start with. However, as the month continued, we saw that bearish sentiment coming back into the market for euro against US dollar and pushing and closing lower. So now when we look at the week, the new week of March, you can see that pretty much most of February, in fact, we saw price actually trading above the monthly fib level here at the 61.8 level at, what's that now, the 112115 level. You can see a lot of consolidation. Price had effectively not broken the current weekly support level that we saw on the, I think it was the close on the 18th of the 1st of January. So since the last week of Jan, you can see that we saw no further lows on the weekly time frame, and subsequently price actually formed this bullish harami, and then price actually managed to maintain above the 61.8. It didn't continue to the upside as we heard further uncertainty in and around Eurozone, resulting in a Greek non-confidence outcome there. So we saw a lot of hesitation for price. It's still maintained above the 61.8. But you can see that the candles were very, very small, non-directional, and very hesitant. So that's consolidation in very much what is still very much a negative trend. You can see the indicator box over here, primarily telling us we should be looking for further negativity. And the last week going into February, we saw a bearish engulfing candle. This bearish engulfing candle now engulfing the prior 3 weeks of the data and getting back below that 61.8 level. So now, looking forward into March, all I want to see now is that 61.8 level becoming or remaining as our resistance level through March period, and then we look to see if we're going to see any continuations to the downside. Notice that the last week's candle, even though it closed lower than the prior weekly high, it still closed below the 61.8, but it failed to do one thing, and that bearish sentiment failed to close lower than the January low, which was down here, which was this level over here, and we're looking at roughly the 110.638 level. So ideally, looking into March, if we are to see any continuations in a negative trend, which is what euro is, then we would want to see this level, support level here, or the January support level, being breached before we see any further opportunities or continuations to the downside. We could start looking towards that 76.4, the 78.6 level down below us, and between the low in January to those current levels to the downside, we're looking in excess of 960 odd pips. Not going to get all of that, but there's more than enough on the table for us to actually make a value return in time invested. So there's a lot of potential pip profit below us, but we would want to see price continuing. The moment now, we haven't seen a continuation over the last month, and price has been consolidative. We don't want to trade consolidation, we want to trade trends. So we need to see a new low, and vitally we want to see a new low on the weekly to then give us an indication that we should be looking for further negative sentiment to the downside. If price fails to break the current January low, we're likely to see further consolidation along this level around the 61.8 level, which is a major support level, has been a support level for the best part of a month now. And if we fail to see that support level being breached, then we start to see more bias, bullish bias creeping in, because there's no selling pressure. Remember, if we're on a negative trend, we need to see new lows. The longer we fail to see a new low, the less selling pressure is on board, which will then start to see more buyers coming into effect, which would then see a potential change in market sentiment. See how I'm thinking now, very mechanically. So therefore, I would want to see, if we are to see any continuations, like to see the current support level being broken before we look or even attempt at looking any further trading opportunities in this case. So looking down at the daily now, just pan it out so we can see more of the chart. There we go. You can see quite a negative outcome on Thursday, and then you can see Friday. Very little movement after that bearish engulfing candle. So even though we saw some very strong movement on the Thursday, we failed to see, we've actually failed to see that momentum actually moving the market any further. So pretty much trading just a fundamental news announcement there and then, short and sweet. But you can see that price in doing so has formed a new swing low, and that you can see the candlesticks very much negative. You can see before then we actually had a blue arrow and the red candlesticks. Here we have a red arrow and the candlesticks are red. Everything is back in favor again. So Friday's close, even though it was indecisive, was still at the underside of the 61.8. So now if you want to be aggressive, you could do two things. You could either target the January low down here very aggressively between these 2 points, or be passive, give that back to the market, get a valid, genuine continuation candle because she's trading below 61.8. Then we'll likely see further continuation. And being more passive, give that to the market. We're looking in excess over here of roughly 120 odd or 112 pips or so. Give that back to the market. By doing so, if she's genuinely moving with further negative bias, then we're likely to see a 900 odd pip return. So giving away 100 to make 900 is not a bad option at all. Okay, there again, if you want to be very, very aggressive, you can either look for any one of these days preceding in the coming week to give you an entry and then trade aggressively to the January low and then close half of that position and let the remainder run, or add more to that position and let it run to those lows we saw down the bottom. I've just gone ahead and thrown my weekly pivot point projections for the forthcoming week. So this is taking last week's data, the open, high, low closes, putting it through an algorithm and giving you these the weekly pivot, and then weekly S1, S2, S3 to the downside, and then the weekly R1, R2, R3 levels to the upside. So now, as I mentioned to you, we saw a bearish engulfing candle on the weekly, on the daily Thursday close. You can see we actually went into the support level 1 here on the weekly, and price is now trading around that level. If we can get a continuation candle closed lower this coming week, then weekly S3 would be our first likely target, which is roughly around the 11170 level. And between these 2 points, you're looking in excess of 81 pips. There again, by the time you get a genuine confirmation candle close, just drop down to the 4 hour just to show you that, then you're looking for a continuation. So there's our weekly S3 level, support level to the downside. You can see that on the 4 hour time frame, here everything's in favor. But you can see that the oscillator is clearly still dark red in color. So we've got to wait for that to turn bright red. And then we have a confluence here where we should be looking low again. A lot of indecision here, not a real true momentum candle. And then we can look to target this level here at 1170 for the first part of this week, which brings us back towards just short of those January lows that I mentioned here at the 110900 mark. So look at those levels for first point of targets for the first coming week of March. Looking at sterling now on the monthly, you can quite clearly see that this month so far, well, February's month, you can see we saw a major pullback on price. We saw a very, very negative January, in fact, after a lot of negative sentiment came out through December. That pushed price lower than the monthly fib level at 23.6, looking roughly around the 1529 level. However, we didn't see any continuation levels or continuation falls through February. In fact, we actually saw consolidation. So if you took the low of January, in fact, and drew horizontal line, we would want any current continuing weekly candle going through February to close lower than the January low to then give us an opportunity to re-enter this trade to the downside. And then we could look at prior support and resistance levels. Here is potential target levels. There's one over here back at the 145-165 long. That failed to materialize, and we failed to see any weekly candles closing lower. Just going to show you that on the weekly time frame. There we go. You can see that we saw 1, 2, 3, 4, 5 consecutive weeks now of upside bias. Okay, and that bias is now, you can see that price is actually consolidated back above the 23.6 level, but also at the underside of that monthly support trend I drew. Okay, if I go back to the monthly and show you that, you can see I took the lows here in 2008. There's a low through 2009, 2010. You can see that pretty much coincides quite nicely with that major support we saw through most of 2013, in fact. And you can see price, the January candle closing lower than that. However, we've seen a pullback, and that's now at the underside of that support level. So are we seeing a breakout pullback to the underside, and now we'd like to see a continuation? So as it stands at the moment now, you can quite clearly see that price is now trading at the underside of that support resistance level, but it's back up above that 23.6 level. So a bit of positiveness now on the weekly. You can see that the intermediate trend down through most of, what was that, from June of last year, in fact, we saw swing lows. That has now been broken here through the last 3 weeks of February, in fact. So got to see price getting back above that level. What we can do is apply the pivot points to this particular chart. You can see quite clearly the monthly R1, resistance level 1, is in play right now. And as long as price is resisted by that, you can quite clearly see the last 3 weeks, in fact, we've seen price trading higher than that support and resistance level here, the monthly pivot point R1. But you can see that prices fell to close higher than that. In fact, we saw price actually attempting those highs on the last week's close. However, you can see the 20-period moving average acting as a resistance level above it, and price is still pretty much ranging. We want to see more of a confirmation candle. We have seen some fantastic figures out for sterling over the past couple of weeks, but it comes back down to the underlying issue, and that underlying issue now at the moment now is far greater than sterling positive figures, and that's Greece. Greece is a major issue, a thorn in the side for Eurozone, and even sterling, after posting some fantastic figures, is still very much wary about what's happening in the Eurozone. So the underlying issue at the moment now is still currently Greece, and until we find out what actually happens with Greece, and then we're likely to see further consolidation, and we're seeing exactly the same thing over here. So looking at this week, in fact, if we are to see any further pullbacks or with what we've seen over the past 5 weeks, then we would want to see the current blue horizontal line there being broken. We would want to see the 20-period moving average being breached. We would want to get back above that green horizontal line that I've just drawn there, this trend line over here, which happens to be the major long-term support level support level that I showed you, the support trend line. And you can see that we still have red candles. There's no blue arrows and no blue candles, even the RMO is below and the OSM is still above. So we have you can see the indicator box here not really giving us a real true bias at the moment now. So as it stands at the moment now, we still have hesitation or consolidation. Yes, it's not making any new lows, but we're not seeing any new current highs, and there's a lot of resistance, support and resistance at where price is trading right now. So we look to this week to see if there's any major news announcements that could actually factor into price action for this particular pair. We've got some important news out for sterling this week in terms of manufacturing PMI results, construction PMI results. We have service PMI results. We have interest rates announcement on Thursday, in fact. Still don't expect a change of 0.5%. There's a lot of factors and that includes non-farm payroll. So there again, we could see some sort of data return which could actually make a major change in market sentiment at the moment now. But as it stands, there's still consolidation. We would want to see new highs. Until such time as that occurs, rather wait for a confirming candle going forward. Onto the US dollar Swiss franc. Here again, let's just pan and have a look at the monthly, how the monthly is actually panning out. You can see that we haven't seen any new lows. In fact, the US dollar Swiss franc was seen prices making a move to the upside and now taking back whatever she lost through the first part of 2015. So if we look down at the weekly time frame, you can see the indicator box over here pretty much blue. There's one or two. You can see the weekly time frame. There's a lot of red arrows, including the R squared, which is not really moving with price. You can see linear regression is also looking good, but you'll notice that price is actually pulled back. Now we take the entire range, January's range, in fact, that negative candle. You can see the 23.6 level was breached, support was found, and then we targeted the 38.2, which clearly went straight through it and went straight up to the 50% level. Price actually hung around there for a full week, and then we saw price breaking higher, finding a bit of support, and then kicking on towards that 61.8. Most of last week, in fact, we actually saw price trading below the 61.8. But as we headed into the end of the week, last week, we actually saw price closing higher. So as it stands at the moment now, 0.9496. If this remains to be our support for the first week of March, then we're likely to see price kick on back up towards this major support and resistance level here, roughly around the 23.6 on the monthly time frame, but also the 78.6 level on the actual range of this bearish candle. So what we're looking for on the daily is for price now to maintain above the 61.8, okay, which is clearly what she's doing at the moment now. A lot of indecision candles, but as long as she uses that 61.8 as a support, then we're likely to see price kicking on to back up to the upside. This is the US dollar Swiss franc. There's a lot of data out this week relating to the US economy. That includes non-farm payroll. The non-farm payroll results, they're expecting a contraction, in fact. They're expecting, in fact, 17,000 less jobs to be created for last month, in fact. So if that happens and that figure is true, then we're likely to see some US dollar negativity against its crosses. So there again, we would see a potential pullback for price, but wait and see what happens to see if we get any further move into the upside for this particular pair. So a lot of consolidation at the moment now. Looking forward, if we are to see any further upside, as long as 61.8 actually acts as a support level, then we're likely to see price continue to the upside. A lot of positiveness here. One or two areas here, especially in the weekly, not really tabbing up the moment now. So we'll look to see if there's any data out this week that could actually warrant a change in market sentiment or failing to push price higher, and we could see pullbacks, or looking to see if price of the US dollar gets some favorable data, which is then going to push it higher towards that level around here at the 9738. That needs to be seen. US data, we have Fed Chairman Yellen speaking on Wednesday, followed by the ADP non-farm unemployment change results. And they're expecting the employment to change there on the ADP of 7,000 new jobs. And then we have the non-manufacturing PMI results to follow on Wednesday. Then Thursday, nothing pretty much major out on Thursday for the US economy. However, that's on Friday is all different. We have non-farm payroll, and we also have the unemployment rate figures coming out. So very, very important this week to find out how that goes, because that's obviously going to have a major impact on what happens on the US dollar Swiss franc, and also my next pair, which is the last pair I'm talking about, which is the US dollar Japanese yen. Here's the US dollar Japanese yen. As promised, the last pair we're going to look at today, you can see on the monthly, we saw December resistance. Okay, indecision candle spinning top, resistance here at the 61.8, which is the monthly fib level here at 120.147. Indecision, price not making new highs, led to January pullbacks as expected. However, we didn't see any new lows being forged through February. In fact, we actually saw a bullish engulfing candle forming. That fell to still close higher than the 61.8. You can quickly see as we head into the end of February, in fact, we saw prices testing the 61.8 but failing to close. The candlesticks in the monthly are still positive. RMO is still above. You can see the indicator box is primarily blue, but the weekly, like its US dollar Swiss franc counterpart, is showing a lot of negativity, especially in the linear regression and the R squared, not complementing each other. You'd like those two to be working with each other to really give us a genuine bias to the upside. We failed to see any new highs over the past three months, in fact. Not a good sign. And that's pretty much showing you quite clearly what's happening on the weekly. You can see here a very tight consolidative range. Prices, we have a red arrow. However, the candlesticks are still blue. So the bias is still wanting to move higher effectively, but we're not seeing any new highs. And we have to wait. As part of the template, we've got to see new highs being made in order to look for a genuine opportunity to the upside. Everything's telling me we should be looking for upside. However, if we don't see any new highs, there's likely for us to stop looking up or long. Then we could see further negativity creeping into price at the moment. So what we need to see in March, in fact, is that 61.8 level at 120.147 being broken, and a blue arrow to form below the blue candles, the RMO, and then the OSMA to get back above that zero level, which will then tell us the bias is looking positive. At the moment, it's below. The longer we see consolidation, the more the OSMA is going to actually remain below the zero level, and that will ideally start to look more negative as less buying pressure comes on board and more selling pressure takes hold of price. So here, what we're looking for in March is a break above the 61.8, to look for any further highs. Failure to see that occur through March would mean that we're seeing less buyers or bias to the upside and more bias to the downside as more selling pressure comes on board. Okay, and that would then look for bearish engulfing candle over the week to then tell us we should be looking to the downside. If that is generally the case, then what we want to see is price getting below this 118049, which is the monthly pivot line, and then we could target back towards these levels to the downside. And those levels are the monthly S1, which is the level of first target of 115352. Then we have the monthly S2 level here at 113152, and then we're looking at monthly S3 back below the 50% fib retracement level here at 110462. So R1, you can see the monthly R1, clearly a major support and resistance level here at the 61.8. Pretty much concurs. So we have a major resistance above us, and price is still above that monthly pivot. As long as she maintains above the monthly pivot, the bias is still looking upside. So we fail to see price making new highs, and we have a bearish engulfing candle closed low on the weekly or this week, then that would potentially set up prices to fall short or trade lower, and then we have our valid targets to the downside. 115352 would be a potential target level, followed by 113152, and ultimately back towards this 50% retracement on the monthly time frame here at 11163 before we see the SL2. So here again, bias is up, but we need to see new highs. Failure to see new highs would then start to look more negative, and then we should be looking to the downside. Okay guys, that's it, short and sweet. Hope you found it effective. Please be vigilant. First week of March means non-farm payroll. Every new first Friday of a new month represents non-farm payroll, which is a major piece of data for the US economy. Very, very important. Wednesday to Friday, we tend to see a lot of data coming out. It's vitally important that you're aware of it. Please factor it in when you're looking at it in your trading pairs. Please don't trade blind. Always be aware of the fundamental data that's likely to come out, and how is that data likely to factor into any pairs that you are trading. Okay, you don't want to be going long short when you've got a major news announcement coming out for that particular pair. Be aware of it, factor in what the outcome is likely to do to the pair, wait for the news announcement to come out, and see how price reacts to that news announcement, and then we trade the outcome. If it's still going with long-term trend, i.e. up or down, that we're looking for genuine opportunities, entry opportunities, and then we just back it up with strong money management rules. Okay, so please be vigilant. I'm going to leave you with that. I'm going to hope you have a fantastic week. Please keep it simple and trade serenely.